Imagine you've spent months, maybe weeks, just poring over financial documents, digging through ledgers, challenging assumptions, and gathering this, mountain of evidence. You're a financial detective, really.
Yeah, that's a good way to put it.
And now it's time. Time to deliver your final, weighty verdict. The independent auditor's report.
Right.
This isn't just some dusty formality, is it? It's arguably the most critical thing a statutory auditor provides. It's this powerful statement carrying immense weight for everyone who relies on those financial statements.
Absolutely right. And, when an auditor expresses an opinion in this report, they're taking on a huge responsibility. Think about it. Countless stakeholders, investors, creditors, you name it, they depend on these financial statements. And, by extension, they depend on the auditor's expert views for their critical economic decisions. This reliance is precisely why it's non-negotiable for the auditor to be incredibly careful, vigilant, and objective in preparing every single word of that report.
It's all about trust, isn't it?
It's about trust, plain and simple. Yeah.
Welcome to the Deep Dive. Today, we're taking a deep dive into the intricate world of audit reporting. Our mission for you, especially if you're preparing for a case-based exam, is to cut through the complexity. We want to equip you with not just the theoretical knowledge, but the practical understanding. We're zeroing in on the standards on auditing, the essays that govern how auditors express their expert views.
Right.
And this isn't just dry textbook stuff. It's about grasping the nuances, the very specific language, and the real-world implications. Stuff that'll empower you to, ace those scenarios.
Yeah, exactly. Our goal in this step dive is to give you a really comprehensive review of all the key concepts. We'll be using the precise language and terminology found right there in the standards. So you become really familiar with how these ideas are expressed. Then we'll explain exactly how these concepts are applied in real-world situations and, crucially, in exam-style scenarios. We'll even walk through an integrated case study that kind of brings it all together, distilling the complex guidance and the bare standards into clear, actionable knowledge you can actually use.
And it sounds like quite a journey. We'll be navigating through a whole series of crucial standards on auditing, starting with SA 700, which is all about forming an opinion.
Foundation.
Then moving to SA 705 for modifications to that opinion. Because, let's face it, sometimes things aren't so clean.
Nope, definitely not.
We'll cover SA 706 for those crucial emphasis of matter and other matter paragraphs. SA 701 on key audit matters CAMs.
Yep.
SA 710 for comparative information, and SA 720 concerning other information. But we won't stop there. We'll also anchor these essays in the vital legal framework of the Companies Act 2013, including the Companies Auditors Report Order 2020, CRO 2020.
CRO, yeah. Very important in India.
Okay, so let's unpack this. IA SA 700. Forming an opinion and reporting on financial statements, the foundation of auditor communication.
Okay, so we begin our deep dive with SA 700. This standard on auditing really lays the foundational groundwork for, pretty much everything that follows in audit reporting.
Right.
It outlines the auditor's core objectives once they've concluded all their field work and, have drawn solid conclusions from the audit evidence they've gathered.
And when you say core objectives, what specifically are those two primary aims? What's the auditor actually trying to achieve by the end of all this meticulous work?
Good question. As per SA 700, there are indeed two main objectives. First, the auditor has to form an opinion on the financial statements.
Okay.
This is the ultimate synthesis of all those facts, figures, analyses. It's about pulling everything together to arrive at a professional judgment regarding the financial health of the entity.
Makes sense.
Second, and equally crucial, the auditor must express that opinion clearly through a written report. This report is the tangible culmination of all the audit work, presented formally and unambiguously. It's the auditor's definitive voice speaking directly to the users of the financial statements. And this is where the auditor really tucks on that significant responsibility we talked about earlier.
Yeah.
Because investors, creditors, other stakeholders, they truly rely on these expert views. That's why the auditor's careful, vigilant, and objective approach in preparing this report is absolutely non-negotiable. It's about being the steadfast guardian of financial credibility.
That makes perfect sense. Now let's talk about the auditor's opinion itself, what it looks like, and, maybe more importantly, what it truly means. The ideal scenario, what everyone hopes for, is the unmodified opinion. often called a clean opinion, right?
Exactly, a clean opinion.
When does an auditor issue one of these?
An unmodified opinion is expressed when the auditor concludes that the financial statements are prepared in all material respects in accordance with the applicable financial reporting framework, or FRF.
The FRF.
Yeah, the FRF is basically the set of rules, like accounting standards, that define how financial statements should be prepared.
I see. And I understand there are different types of these financial reporting frameworks that affects the wording.
Yes, precisely. There's a subtle but important distinction in wording depending on the framework. If the financial statements are prepared under what's called a fair presentation framework,
Okay.
which means the framework allows for fair presentation even if it means departing from a specific standard in rare disclosed cases.
Oh, okay.
Then the opinion uses phrases like, in our opinion, the accompanying financial statements present fairly in all material respects in accordance with the applicable financial reporting framework. Or alternatively, 2, in our opinion, the accompanying financial statements give a true and fair view of DEN in accordance with the applicable financial reporting framework.
Okay.
And it's vital for your exam to remember that these two phrases are considered equivalent. They convey the exact same level of assurance.
So, same assurance, just slightly different wording. What about if the financial statements are prepared under a compliance framework? How does that change things?
Right. If it's a compliance framework which dictates strict adherence to standards, even if it might lead to a less fair presentation in rare circumstances because there's no allowance for departure, then the opinion states, the accompanying financial statements are prepared in all material respects in accordance with the applicable financial reporting framework.
More rigid.
Exactly. It's a more rigid statement focused purely on adherence.
And central to forming any of these opinions is a concept we hear a lot about, materiality. To issue an unmodified opinion, the auditor must conclude that reasonable assurance has been obtained. What does reasonable assurance really mean in auditing, and how does materiality fit in?
Okay, reasonable assurance. It's a high level of assurance, but it's really important to understand it is not a guarantee.
Right. Not absolute certainty.
No, auditors don't provide absolute certainty. The goal is to be reasonably assured that the financial statements as a whole are free from material misstatement, whether due to fraud or error. Now, for materiality, misstatements are considered material if, individually or in the aggregate, they could reasonably be expected to influence the economic decisions of users taken on the basis of these financial statements. So, it's about the significance of an item to the user's decision-making.
If it would sway an investor or a creditor,
Then it's material. Exactly.
and here's where it gets really interesting, especially for exam prep. When expressing an unmodified opinion, the standards explicitly state that it is not appropriate to use phrases such as with the foregoing explanation or subject to in relation to the opinion. Why is that? It seems like such a small phrase.
That's a fantastic point, and it goes right to the heart of audit credibility.
Mhm.
See, in the world of financial trust, ambiguity is just, well, it's poison. Those phrases with the foregoing explanation or subject to, even subtly, suggest that the auditor isn't fully standing behind their work.
Like they're hedging their bets.
Precisely. Or that their opinion is conditional. This instantly erodes the credibility that takes years, sometimes decades, to build. An unmodified opinion must be clear, unequivocal, without reservation. Any hint of a condition or a disclaimer would just undermine the entire purpose of providing independent assurance. It's about maintaining absolute, unwavering confidence in the auditor's stance.
Powerful. Okay, now that we understand the opinion itself, let's get into the nuts and bolts.
Seymour.
The mandatory elements of the independent auditor's report. What are the non-negotiables that have to be in every report?
Okay, the structure. First, the report must have a title. Something like Independent Auditor's Report.
Okay.
This isn't just a label. It clearly distinguishes it from reports issued by others, signifying the independent nature and authority of the audit function.
Yeah, the addressee. Who's this report typically for?
The report is addressed as required by the circumstances of the engagement. So for general purpose, statutory financial statements, it's almost always addressed to the members of the company.
Shareholders.
Right. But if it's for special purpose financial statements, it might be addressed to the board of directors or even another specific party, depending on who commissioned the audit and who the primary users are.
The third, and probably the most anticipated element, is the auditor's opinion section. I assume this is right up front.
Absolutely. It's the very first section of the report, and it must have the clear heading opinion.
Oh, okay.
It does several vital things. It identifies the entity and states that its financial statements have been audited. It lists the title of each statement, balance sheet, P&L, cash flow, and refers to the notes, including the summary of significant accounting policies. And it specifies the exact date of, or period covered by, each financial statement.
Very precise.
Yes, this meticulous identification ensures absolute clarity on exactly what has been audited.
Following the opinion, we have the basis for opinion section. This sounds like where the auditor justifies their conclusion.
Exactly right. This section is crucial because it provides the essential context for the auditor's opinion. It explicitly states that the audit was conducted in accordance with standards on auditing, SAS. It also declares the auditor's independence from the entity, affirming adherence to relevant ethical requirements, referencing the ICAI's Code of Ethics and Companies Act provisions, for instance. And critically, it affirms that sufficient and appropriate audit evidence has been obtained to provide a robust basis for the opinion.
So reassuring the reader.
Precisely. It reassures users that the opinion isn't just pulled out of thin air, but grounded in solid, verifiable evidence.
Next up, the going concern section, though this is only included if applicable under SA 570. What's the trigger here, and what's that crucial nuance we need to remember for the exam?
Okay, going concern. This section applies if the auditor concludes that a material uncertainty exists related to events or conditions that may cast significant doubt on the entity's ability to continue as a going concern. But here's that crucial nuance for your exam. This section is included only if adequate disclosure about this uncertainty is made in the financial statements by management.
Only if it's disclosed.
Exactly. It states that these events indicate that a material uncertainty exists and explicitly notes that the auditor's opinion is not modified in respect of the matter. This is a common exam trap.
I can see that.
If adequate disclosure is not made, this situation would actually lead to a modified opinion under SA 705, not just this section. The distinction hinges entirely on whether management has appropriately disclosed the issue in their financials.
That's a subtle but incredibly important distinction. Then we have the key audit matters section, governed by SA 701, again, if applicable.
Right, CAMS. This section is mandatory for listed entities, and also when the auditor just decides it's important to communicate them. It identifies those matters that, in the auditor's professional judgment, were of most significance in the audit. It explicitly states that these matters were addressed within the context of the audit of the financial statements as a whole, and this is key. The auditor does not provide a separate opinion on these matters.
Not a separate opinion.
None. If no CAMs are identified, the report should state this clearly, for example. Except for the matter described in the basis for qualified adverse opinion section or material uncertainty related to going concern section, we have determined that there are no other key audit matters to communicate in our report. We'll dig deeper into comms later as they really do enhance transparency.
And the other information section under SA 720, what's that about?
This is included for audits of listed entities and unlisted corporate entities where the auditor has obtained some or all of the other information.
What is other information?
It refers to financial or non-financial data included in the annual report, but not actually part of the core financial statements themselves. Think management reports, directors' reports.
Got it.
The section states that management is responsible for this other information and, crucially, clarifies that the auditor's opinion does not cover the other information, and, accordingly, that the auditor does not express an audit opinion or any form of assurance conclusion thereon.
So no opinion on that stuff.
Right. It describes the auditor's responsibilities to read it and check for consistency, and then reports whether there is nothing to report, or, if applicable, describes any uncorrected material misstatement found in that other information. We'll explore SA 720 in more detail shortly.
Next, the responsibilities for the financial statement section. This clarifies who's accountable for what, right? Management versus governance.
Precisely. This section primarily describes management's responsibilities. This includes preparing the financial statements according to the FRF, setting up and maintaining internal control necessary for financials free from material misstatement, and assessing the entity's ability to continue as a going concern, including making all relevant disclosures. It also identifies those charged with governance, or PCWG, often the audit committee or board, if they're different from management, stating their responsibility for overseeing the entity's financial reporting process.
So clear lines drawn.
Yes, this clear delineation of roles is essential for users to understand who is accountable for what piece.
And then the mirror image. The auditor's responsibilities for the audit of the financial statements. This sounds like a deep dive into the auditor's own role.
It is. The section states the auditor's overarching objectives. Quote, to obtain reasonable assurance about whether the financial statements as a whole are free from material misstatement, whether due to fraud or error, and to issue an auditor's report that includes the auditor's opinion.
Reasonable assurance again.
Yes, and it explicitly clarifies that reasonable assurance is a high level of assurance, but is not a guarantee. It also re-emphasizes materiality, explaining that misstatements are considered material if, individually or in the aggregate, they could reasonably be expected to influence the economic decisions of users.
Here's where it gets really interesting for me.
Yeah.
It mentions the auditor exercises professional judgment and maintains professional skepticism throughout the audit. That's not just jargon, is it? What does that look like in practice?
Oh, it's absolutely fundamental. It's not jargon at all. Professional judgment means applying expertise and knowledge to make informed decisions, often in the face of uncertainty.
Right.
Professional skepticism means having a questioning mind, being alert to conditions that might indicate possible misstatement, and critically assessing audit evidence. You don't just accept things at face value.
A healthy dose of doubt.
Exactly. So in practice, this section describes the auditor's specific responsibilities, including identifying and assessing risks of material misstatement, whether from fraud or error, designing responsive procedures, and obtaining sufficient appropriate audit evidence. It also highlights a critical point. The risk of not detecting a material misstatement resulting from fraud is higher than for one resulting from error.
Why is that?
As fraud may involve collusion, forgery, intentional omissions, misrepresentations, or the override of internal control. It's actively hidden. This requires heightened skepticism.
So it's about being both a diligent detective and a careful judge, right? What are the key responsibilities that are listed here?
Precisely. The auditor also gets an understanding of internal control relevant to the audit, but typically not for expressing an opinion on its effectiveness unless, a separate opinion is legally required. They evaluate the appropriateness of accounting policies, the reasonableness of accounting estimates, and related disclosures made by management. They conclude on the appropriateness of management's use of the going concern basis, and if a material uncertainty exists, draw attention to disclosures or modify the opinion if disclosures are inadequate. They also evaluate the overall presentation, structure, and content of financial statements, including disclosures, to ensure fair presentation. This section also describes responsibilities in a group audit under SA 600, including the division of responsibility if other auditors audited components. And importantly, the auditor communicates the planned scope and timing of the audit and significant audit findings, including any significant deficiencies in internal control, with those charged with governance.
DCWG.
And provides a statement of independence and related safeguards.
And where does all this expensive detail about the auditor's responsibilities usually live in the report? Can it be somewhere else?
It can be included directly in the report itself, or in an appendix to the report, or sometimes it's referenced on a website of an appropriate authority if that's permitted and consistent with the essays.
Finally, we have the Other Reporting Responsibilities section. When does this come into play?
Right. If the auditor has additional reporting responsibilities mandated by law or regulation beyond just the essays, which is quite common in many places, like India, these are addressed in a separate section. It usually has a heading like Report on Other Legal and Regulatory Requirements.
Keeps things separate and clear.
Exactly. It clearly differentiates the general purpose statutory reporting from other specific legal duties.
And to wrap up the structure, we have the signature, place of signature, and dated the auditor's report, the final sign-off.
Yeah, the final pieces. The report is signed by the auditor, including their seal and membership number. Since July 1st, 2019, in India, for example, it's mandatory to include the Unique Document Identification Number, or UDIN,
right,
for both manually and digitally signed reports. This really emphasizes professional accountability and traceability. The place of signature is the specific location, ordinarily the city where the audit report is signed, and the report is dated no earlier than the date on which the auditor has obtained sufficient appropriate audit evidence on which to base the auditor's opinion, including evidence that all financial statements with notes have been prepared and management has taken responsibility for them.
So that date is critical.
It is. It defines the period for which the auditor takes responsibility. Any events after this date are generally outside the scope, unless there is a significant subsequent event that needs addressing. SA 705, modifications to the opinion in the independent auditor's report when the audit findings demand a different view.
Okay, now let's talk about what happens when things aren't clean, when the auditor can't issue that unmodified opinion. SA 705 kicks in when the auditor's findings demand a different view, leading to modifications. What's the core objective of this standard?
Well, The main objective of modification, according to SA 705, is for the auditor to issue an appropriate report when they conclude that the financial statements as a whole are not free from material misstatement, or when the auditor is unable to obtain sufficient appropriate audit evidence to form an unmodified opinion.
Okay.
In such cases, a modified opinion is absolutely necessary because the financial statements, as presented, can't be fully relied upon by users.
And central to determining the type of modification is understanding a critical term: pervasive. This isn't just a synonym for big, is it? How do we precisely define pervasive in this auditing context?
You're absolutely right. It's much more nuanced than just big. Pervasive describes the effects, or the possible effects, of misstatements on the financial statements. Effects are considered pervasive if they are not confined to specific elements, accounts, or items of the financial statements.
So widespread.
Right. Or, if they are confined to specific elements, they represent or could represent a substantial proportion of the financial statements. And in relation to disclosures, they are fundamental to users' understanding of the financial statements. Think of it this way. It's not localized. If something impacts multiple areas or a single area so significantly that it distorts the whole picture.
Like a domino effect?
Kind of, yeah, or just a huge chunk. It's pervasive. It's not just a minor crack. It's affecting the whole foundation.
That's a really helpful analogy.
Yeah.
Can you give us an example to illustrate that distinction between something being material but not pervasive versus material and pervasive?
Sure. Let's say an auditor can't get sufficient audit evidence only for inventory because, I don't know, the records were destroyed in a localized warehouse fire.
Okay.
If other elements of the financial statements, cash, receivables, fixed assets are properly supported, the impact on inventory is localized. It's material, sure, but maybe not pervasive in itself. However, if that inventory makes up, say, 40% of total assets, then its potential misstatement could be considered pervasive because it represents a substantial proportion of the financial statements. This significantly affects users' understanding of the entity's overall financial position, not just one line item.
The sheer size makes it pervasive then.
Exactly.
Like,
the magnitude tips it over into pervasive territory.
that makes a lot of sense. So with pervasiveness clarified, let's dive into the 3 categories of modified opinions. Where do we start?
Okay, first, we have a qualified opinion. This is the least severe of the modifications. The auditor expresses a qualified opinion in 2 main scenarios. One, when having obtained sufficient appropriate audit evidence, they conclude that misstatements are material but not pervasive to the financial statements. Like, maybe a specific accounting policy departure that affects one major item, say how a unique revenue stream is recognized, but it doesn't fundamentally distort the entire financial picture. 2, when the auditor is unable to obtain sufficient appropriate audit evidence, but concludes that the possible effects of undetected misstatements, if any, could be material but not pervasive.
So a scope limitation, but localized.
Exactly. Think of it as a significant problem, but one that is isolated and doesn't fundamentally compromise the overall reliability of the financial statements.
And how is that reflected in the wording in the opinion paragraph? Does it use specific phrasing?
Yes, it does. It would state, in our opinion, except for the effects of the matter described in the basis for qualified opinion section, if it's for a detected misstatement.
Okay.
Or except for the possible effects of the matter if it's due to an inability to obtain sufficient evidence. That except for is the key signal.
Let's consider a classic exam-style scenario from the source to illustrate this. If XYZ Ltd has financing arrangements about to expire, indicating a material uncertainty about its going concern status, but the financial statements do not adequately disclose this matter, what then?
Yeah, this is a common exam trap. In this case, C.A. Sudhir, the auditor, would express a qualified opinion.
Why qualified?
Because the inadequate disclosure, the omission of a material piece of information, constitutes a misstatement by omission. It's material because it would influence user decisions, definitely. But it's likely not pervasive if the company's underlying operations are still somewhat stable, and the issue relates to a specific financing event rather than the entire business model collapsing.
The lack of disclosure is the misstatement.
Exactly. Had it been adequately disclosed, we might have considered a going concern section or an emphasis of matter, but since it's not disclosed, it leads to a modification, a qualified opinion in this case.
Okay, the second type is the most severe. An adverse opinion. When is that expressed? This sounds like a real red flag to users.
An adverse opinion is indeed a huge red flag. It's expressed when the auditor, having obtained sufficient appropriate audit evidence, concludes that misstatements, individually or in the aggregate, are both material and pervasive to the financial statements.
Both material and pervasive.
Yes. This is a strong statement, essentially indicating that the financial statements are not presented fairly in accordance with the applicable framework. The wording in the opinion paragraph explicitly states that the accompanying financial statements have not been prepared, in all material respects, in accordance with the applicable financial reporting framework. Basically, these financials are fundamentally flawed.
So, if ABC Ltd's financing arrangements have expired, it's looking at bankruptcy, indicating a material uncertainty, a going concern, making it unable to realize assets or discharge liabilities normally.
Yeah.
And crucially, the financial statements do not disclose this fact. How does that differ from the previous XYZ Ltd example?
Right. In this much more severe situation, C.A. Prakash would express an adverse opinion.
Adverse, okay. Why?
Because the events leading to near bankruptcy mean the fundamental basis of accounting, the going concern assumption, is probably inappropriate. And the lack of disclosure on such a pervasive issue means the entire financial picture is fundamentally misleading. The misstatements, the omission of this critical information, are both material and pervasive because they fundamentally distort the user's understanding of the entity's viability.
It's not just one item, it's the whole foundation.
Exactly. It's the very foundation that's cracked.
And finally, the disclaimer of opinion. This truly sounds like the auditors just throwing their hands up and saying, I can't even give you an opinion.
In a way, yes, that's precisely what it signifies. A disclaimer of opinion is expressed when the auditor is unable to obtain sufficient appropriate audit evidence on which to base an opinion, and the possible effects on the financial statements of undetected misstatements, if any, could be both material and pervasive.
So a massive scope limitation.
Usually, yes. It typically arises from severe scope limitations, meaning the auditor cannot gather enough reliable information to form any opinion at all. It's also used in extremely rare circumstances involving multiple uncertainties, where even if the auditor can gather sufficient evidence for individual uncertainties, their potential interaction makes it impossible to form an opinion on the financials as a whole.
And how is that stated in the report?
The opinion paragraph states, "We do not express an opinion on the accompanying financial statements of the entity because of the significance of the matters described in the basis for disclaimer of opinion section of our report. We have not been able to obtain sufficient appropriate audit evidence to provide a basis for an audit opinion on these financial statements." Very direct.
Let's apply this with another illustration. If Mins PRT and Associates are unable to obtain sufficient appropriate audit evidence about a joint venture investment that represents over 90% of the entity's net assets. What's the outcome? That sounds extreme.
It is extreme. In that instance, the possible effects of this inability to obtain evidence are clearly both material and pervasive. A 90% chunk is huge. Therefore, a disclaimer of opinion is issued.
Okay.
You'll also find some special considerations for a disclaimer. When an auditor disclaims an opinion, the report shall not include a key audit matters section unless specifically required by law regulation, or a statement about the sufficiency of audit evidence.
Why not?
Because if you can't form an opinion, you can't really highlight specific key matters, can you? Or claim you've got enough evidence when you clearly haven't.
Makes sense.
The description of auditors' responsibilities is also amended to reflect the fundamental inability to obtain a basis for an opinion.
This brings us to what you've called the opinion decision matrix, something absolutely crucial for the exam. Can you quickly run through how this matrix guides the auditor's choice again?
Yeah, this matrix is your roadmap, really. You consider two factors. The nature of the issue. Is it a material misstatement, something wrong in the financials, or an inability to obtain sufficient appropriate audit evidence, a scope limitation? And second, the pervasiveness of the effect. So if there's a material misstatement, if it's material but not pervasive, qualified opinion. If it's material and pervasive, adverse opinion. Now, if there's an inability to obtain sufficient appropriate audit evidence, if it's material but not pervasive, qualified opinion. If it's material and pervasive, disclaimer of opinion.
Got it. Qualified, adverse, qualified, disclaimer.
Exactly. Mastering this matrix is essential for correctly applying SA 705 in any scenario you might face.
What happens when management itself imposes a scope limitation? Say, they just refuse to provide certain documents that an auditor really needs.
Right, that can happen. If management imposes a limitation that is likely to result in a qualified or disclaimed opinion, the auditor must request its removal. That's step one, non-negotiable. If management refuses, the auditor communicates this to those charged with governance, the TCWG, unless, of course, TCWG are themselves involved in managing the entity. The auditor then determines if alternative procedures can maybe get them sufficient evidence.
Plan B.
Yeah, Plan B. If sufficient evidence still cannot be obtained, the auditor determines the implications for the opinion, which will be either qualified or disclaimed, based on the pervasiveness of the issue.
And could withdrawing from the engagement ever be an option for the auditor in such a severe case, like just walking away?
In some rare extreme cases, withdrawal might be considered, especially if the scope limitation is so severe it prevents any meaningful audit work. However, and this is important, withdrawal might not be permitted by law or regulation in certain situations.
Like for listed companies.
Exactly. SEBI directives for listed companies in India, for example, often prevent an auditor from simply resigning mid-audit. If the auditor cannot withdraw, they must issue the appropriate report reflecting the limitation. If they do withdraw, there may be professional, legal, or regulatory requirements to communicate this to regulators or owners, and any identified misstatements must still be communicated to those charged with governance. It's a very difficult position for an auditor to be in. 3. SA 706. Emphasis of matter, EOM paragraphs and other matter paragraphs drawing attention to key context. Okay, moving on to SA 706. This standard deals with situations where the auditor needs to provide some additional communication in the audit report. It's used when the auditor thinks it's necessary to draw users' attention to specific matters that are fundamental to understanding the financial statements, the audit itself, or the auditor's responsibilities. But critically, these matters do not warrant a modification to the opinion. The main opinion stays clean.
Right. Let's start with the emphasis of matter, EOM paragraph. What exactly is it, and how does it fit into the picture of an otherwise clean opinion?
Okay, an EOM paragraph. It's a specific section included in the auditor's report that refers to a matter appropriately presented or disclosed in the financial statements that, in the auditor's judgment, is of such importance that it is fundamental to users' understanding of the financial statements.
Appropriately presented or disclosed, that's key.
That's the absolute T. And, as we said, the auditor's opinion would not be required to be modified as a result of the matter, meaning the financial statements are already fairly presented regarding this issue. The EOM just highlights its importance.
Okay.
Also, when SA 701 on key audit matters applies, the matter has not been determined to be a key audit matter because CAMs sort of serve a similar purpose of highlighting significance for listed entities.
So if it's already properly disclosed in the financial statements, why does the auditor need to draw even more attention to it? Seems redundant almost.
It's because of its sheer importance and potential impact on a user's decision, even if it's correctly accounted for and disclosed. It's like putting a big spotlight on something already there in the notes.
Okay, so what are some examples?
Common examples for an EOM include an uncertainty relating to the future outcome of exceptional litigation or significant regulatory action, provided it's already adequately disclosed in the notes.
Right.
Another is a significant subsequent event, like a major factory fire, that occurs between the financial statement date and the auditor's report date, again, if adequately disclosed. Or maybe the early application of a new accounting standard that has a pervasive effect where that's permitted. The source illustrates a common EOM paragraph used for the effects of a fire in the company's production facilities, specifically referring to Note X in the financial statements. And the opinion then explicitly states, our opinion is not modified in respect of this matter.
And this is a critical point for the exam, right? That an emphasis of matter is never a substitute for a modification.
Absolutely. The source explicitly clarifies that emphasis of matter is not a substitute for modification of opinion. This is a vital distinction you absolutely must grasp. If a matter requires a modified opinion, for example, due to inadequate disclosure of a material item or a material misstatement, an EOM paragraph is completely inappropriate. Remember, an EOM is only for matters appropriately disclosed and correctly presented. It's an amplification, not a correction or a warning about a flaw.
What about an other matter, OM paragraph? How did that differ from an EOM? They sound pretty similar.
They are distinct, though. An other matter paragraph is a section included in the auditor's report that refers to a matter other than those presented or disclosed in the financial statements that, in the auditor's judgment, is relevant to users' understanding of the audit, the auditor's responsibilities, or the auditor's report.
So outside the financials themselves.
Exactly. The key difference from an EOM is that an OM paragraph pertains to something outside the financial statements, focusing instead on the audit process, the auditor's scope, or maybe the report in context.
So when would an OM paragraph be necessary? Can you give us a few examples where this would typically pop up?
Yeah, common scenarios include when referring to the audit of prior period financial statements by a predecessor auditor, letting users know the current auditor didn't audit those past periods.
Okay.
Or, conversely, when prior period financial statements were simply not audited at all. In those rare circumstances where the auditor can't withdraw from an engagement even with a pervasive scope limitation, maybe due to legal restrictions, and needs to explain this unique situation to users, an OM paragraph might be used. It can also be used to restrict the distribution or use of the auditor's report for special purpose financial statements, making sure it's not misused.
Can you illustrate with some concrete examples from the source? How might that look?
Sure. One illustration provided is the financial statements of ABC Company for the year ended March 31st, 20XS, were audited by another auditor who expressed an unmodified opinion on those statements on March 31st, 20X1. This informs users clearly about the prior period's audit history. Another example clarifies the scope of responsibility in a group audit context. We did not audit the financial statements of 5 branches included in the standalone financial statements of BDS Ltd. These financial statements have been audited by the branch auditors whose reports have been furnished to us, and our opinion, insofar as it relates to the amounts and disclosures included in respect of these branches, is based solely on the report of the branch auditors.
Crucial for transparency about scope.
Absolutely.
This brings us to a crucial distinction: the difference between management's notes on accounts and the auditor's qualifications. This seems like a common area of confusion.
It is, and it's a very practical point. And look, management may prefer to explain their viewpoint or a specific situation via notes in the financial statements. That represents their stand on a matter. However, the auditor, when they disagree with management's presentation or non-disclosure, records that disagreement by way of qualifications in the audit report. The auditor must always exercise professional judgment. Just because management put a note about it doesn't mean it's okay. A modification or even an emphasis of matter might still be necessary from the auditor's independent perspective.
So management's notes don't let the auditor off the hook for a qualification if they fundamentally disagree with the accounting or disclosure.
Exactly right. Qualifications must be clear and unambiguous, explicitly stating the reasons for the negative or qualified answers. Phrases like "except for" are appropriate for qualified opinions, not those vague terms like "with the foregoing explanation" or "subject to." Those phrases we learned are prohibited for unmodified opinions, and they also weaken the clarity of a qualified opinion. A simple reference to notes in the accounts within the auditor's report does not automatically become a qualification. The report must state the matter clearly from the auditor's independent standpoint, not just repeat management's explanation if it warrants a modification. 4. Essay 701. Communicating Key Audit Matters, CAMNAVs, enhancing the communicative value of the report.
All right, let's turn our attention to Essay 701 and the communication of key audit matters, or CAMs. How are these defined, and why are they important enough to get their own section in the audit report for certain companies?
Okay, CAMAVs. They're defined as those matters that, in the auditor's professional judgment, were of most significance in the audit of the financial statements of the current period.
Most significant.
Exactly. And importantly, they are selected from matters that were communicated with those charged with governance, TCWG. This communication is a vital two-way street, making sure the oversight bodies know about the audit's most critical areas, and it forms the pool from which CAMs are selected.
And what's the core purpose behind communicating these CAMs? It seems like it adds a layer of transparency, which is good.
It does, absolutely. The primary purpose is to enhance the communicative value of the auditor's report by providing greater transparency about the audit that was performed.
Okay.
It's designed to assist intended users, investors, creditors, analysts in understanding matters of most significance and areas of significant management judgment within the financials. It can also provide a basis for users to further engage with management and those charged with governance about certain matters, fostering dialogue and deeper understanding.
Makes the audit less of a black box.
Exactly. More of a window into the audit process itself.
When are CAMs required, or when do they typically apply? Is it for all companies?
No, not for all companies. Communicating CAMs is mandatory for audits of complete sets of general-purpose financial statements of listed entities.
Listed entities, okay.
However, the auditor may otherwise decide to communicate key audit matters in the report, even if not a listed entity, if they believe it would enhance the report's value. It also applies when the auditor is required by law or regulation to communicate key audit matters.
And when are they prohibited?
Yes. One critical prohibition to remember is that SA 705 prohibits the auditor from communicating key audit matters when the auditor disclaims an opinion on the financial statements.
Right. The disclaimer.
Unless such reporting is required by law or regulation. A disclaimer means the auditor couldn't form an opinion at all, so discussing specific key matters would be kind of contradictory, wouldn't it?
Yeah, that makes sense. So what are comms not? This seems like a critical distinction for exam scenarios, especially telling them apart from modifications or disclosures.
Absolutely. Understanding what CAMs are not is just as important as understanding what they are. Communicating key audit matters in the auditor's report is not 1. A substitute for disclosures in the financial statements that the framework requires management to make or that are otherwise necessary for fair presentation. Management still owns disclosure.
Okay.
2. A substitute for a modified opinion. If a modification is needed under SA 705 because of a material misstatement or scope limit, CAMs don't replace that. A modification flags a flaw. A CAM highlights a complex area in otherwise fair financials.
Got it.
3. A substitute for reporting going concern uncertainty. It doesn't replace the specific reporting needed under SA 570 when a material uncertainty exists about going concern. That's its own specific beast.
Right.
And 4, a separate opinion on individual matters. The auditor's opinion is on the financial statements as a whole, not on individual CAMs. You can't give a separate opinion on, say, revenue recognition just because it's a CAM. The CAM section just provides context about how the audit addressed those significant areas.
That clarifies it perfectly. So how do auditors actually figure out which matters qualify as CAMs? It must involve a lot of judgment calls.
It does involve significant professional judgment. It focuses on matters that required significant auditor attention during the audit. Key things they consider include 1. Areas of higher assessed risk. This includes significant risks identified under SA 315, like complex estimates, related party deals, areas prone to fraud. Not all significant risks become CAMs, but many do, especially those involving tricky management judgment or unusual transactions.
Okay.
2. Significant auditor judgments. This means the most complex judgments made by the auditor themselves during the audit, especially relating to areas in the financial statements that involve significant management judgment, including accounting estimates, identified as having high estimation uncertainty. Think valuing complex financial instruments or big provisions. And 3. Effect of significant events or transactions. This looks at the impact on the audit of significant events or transactions that occurred during the period, like major acquisitions, disposals, or unusual one-off transactions that took up substantial auditor time and effort.
Does the number of CAMs included in a report vary a lot? Or is there a typical number?
Yeah, it varies quite a bit. The number depends on the size and complexity of the entity, the nature of its business and environment, and the facts and circumstances of the audit engagement. The standards actually caution that lengthy lists can dilute the concept of most significance, suggesting that fewer, truly critical CAMs are probably more effective for users. Quality over quantity.
Once identified, how are key audit matters actually communicated in the report? What's the structure of a good CAM description?
Okay, so the report will have a dedicated section titled Key Audit Matters. The description of each CAM must include a reference to related disclosure in the financial statements, if any. Link it back. Address why the matter was considered to be one of most significance and therefore determined to be a key audit matter. This explains the significance from the auditor's viewpoint, and critically address how the matter was addressed in the audit. This involves explaining the audit procedures performed, key observations, or outcomes relevant to the matter. It tells the user what the auditor actually did.
Dex.
The language should be, succinct, balanced, and try to avoid highly technical auditing jargon to be understandable by intended users who might not be auditors themselves.
Can you give a concrete example? How might a CAM be described for something complex like revenue recognition?
Sure. For complex revenue recognition, a CAM might describe the challenge first, something like, the company recognizes revenues when control of goods is transferred. The terms of sales arrangements, based on contracts and the nature of discounts and rebates, create complexities that require significant management judgment in determining when revenue should be recognized and at what amount.
Sets the stage.
Exactly. Then, it would explain how the auditor addressed it. We reviewed the company's revenue recognition policy and assessed its compliance. We assessed the design and tested the operating effectiveness of internal controls related to sales and rebates. We further tested on a sample basis that revenue has been recognized in the proper period with reference to supporting documents, including customer confirmations and review of contract terms.
Clear actions taken.
Right, and if the auditor determines there are no CAMs to communicate, the report will simply state this clearly, something like, "We have determined that there are no key audit matters to communicate in our report." VSA 710. Comparative information context from past periods.
Okay, moving on to SA 710. This standard helps us understand how auditors deal with comparative information. That's the data from past periods, right? The prior year columns that show up in financial statements providing context. What's its scope and objective?
Yeah, exactly. SA 710 specifically deals with the auditor's responsibilities regarding comparative information in financial statements, amounts and disclosures from one or more prior periods. The core objective is basically to get sufficient appropriate audit evidence that this comparative information is presented correctly according to the FRF, and consequently to report on it properly.
So it's about consistency and context.
Precisely. It ensures consistency and proper contextualization for users, allowing them to track performance and position over time.
Now, the standard describes two broad approaches to presenting comparative information. Can you walk us through them and highlight the key differences for the auditor?
Absolutely. The first approach is called corresponding figures.
Corresponding figures.
Yeah. In this method, prior period figures are presented alongside the current period's financial statements, forming an integral part of these statements. But here's the crucial distinction. The auditor's opinion explicitly refers to the current period only.
Only the current year.
Yes. The corresponding figures are there for comparison, but they're not the primary subject of the current audit opinion itself.
So the auditor's unmodified opinion doesn't explicitly mention the corresponding figures in a standard report. How does that work?
That's right. As a general rule, the auditor's unmodified opinion doesn't refer to the corresponding figures because the opinion is on the current period's financial statements as a whole, which just happens to include those corresponding figures as context.
Okay. But what if there was a problem last year?
Good question. If the auditor's report on the prior period had a qualified, adverse, or disclaimer opinion, and the issue causing that modification is still unresolved in the current period, like a misstated inventory balance from last year is still wrong in the comparative figures, then the auditor shall modify the opinion on the current period's financial statements too. The basis for modification paragraph will either refer to both current and corresponding figures if the effects are material to the current period, or explain the modification is due to effects on comparability if the impact is immaterial now, but still messes up the year-on-year comparison.
What if the prior period was audited by a different auditor, a predecessor auditor? How do we handle that situation?
If the prior period financials were audited by a predecessor auditor and the current auditor is allowed by law or regulation to refer to it and decides to, the current auditor shall state in an other matter paragraph. 1. That prior period FS were audited by a predecessor auditor. 2. The type of opinion expressed by the predecessor and the reasons if it was modified. And 3. The date of that prior audit report.
Provides the history.
Exactly. This transparency informs users of the change in auditors and the prior opinion, giving full context.
And if the prior period wasn't audited at all, that seems like it could be a significant issue.
Yeah, if the prior period financial statements were not audited, the auditor shall state in another matter paragraph that the corresponding figures are unaudited. This doesn't, however, let the current auditor off the hook for checking opening balances.
Right.
They still have the responsibility to obtain sufficient appropriate audit evidence that opening balances for the current period don't contain material misstatements that could affect the current period's financial statements. You still have to check the starting point.
The second broad approach is comparative financial statements. How does that differ from corresponding figures, and what does it mean for the auditor's opinion?
Okay, comparative financial statements. With this approach, full financial statements for each period are presented, side by side essentially. And crucially, the auditor's opinion refers to each period for which financial statements are presented.
So the opinion covers multiple years explicitly.
Exactly. The auditor's opinion shall refer to each period clearly. So if 2 years are presented, the opinion will cover both years.
Okay, and the rest. Modifications, predecessor auditors.
Similar rules apply as with corresponding figures. If a prior period report was modified and it's still unresolved, the current opinion will reflect this for each period and explain why. If the prior period was audited by a predecessor, the current auditor states this in an other matter paragraph with the predecessor's opinion and date. And if the prior period wasn't audited, the auditor states in an other matter paragraph that the comparative financial statements are unaudited while still holding responsibility for opening balances affecting the current period.
So the key difference is the scope of the opinion.
Precisely. covering multiple full periods explicitly rather than just the current one with prior year figures as context. SA 720. The auditor's responsibilities relating to other information beyond the financial statements.
Stepping even further beyond the core financial statements now, we have SA 720, which outlines the auditor's responsibilities for other information. This seems a bit counterintuitive at first. Why are auditors concerned with information outside the actual financial statements? What exactly falls under this category?
That's a great question, and it highlights the auditor's broader role in ensuring the credibility of the entire annual report package, not just the core financials.
Okay.
Other information is defined as financial or non-financial information, other than financial statements and the auditor's report thereon, included in an entity's annual report. The annual report itself is typically a document, or maybe a set of documents, prepared annually by management or TCWG to give owners or stakeholders info on the entity's operations, financial results, position, the glossy report.
The chairman's statement, director's report.
That's exactly. Examples include the management report, director's report, chairman's statement, corporate governance statements.
So if a company issues a separate press release about earnings or a standalone sustainability report, that wouldn't fall under SA 720.
Generally correct. It explicitly does not include preliminary announcements of financial information or securities offering documents like prospectuses. It also doesn't usually include standalone reports like CSR reports or specific regulatory filings unless they are specifically made an integral part of the annual report.
Okay.
And when considering materiality for this other information, it's assessed not just on its own, but in the context of the common information needs of users who read it to provide context to the financial statements. It involves both qualitative and quantitative judgments. Auditors care because if this other information contradicts the audited financials, it could seriously mislead users.
Consistency is key.
Absolutely.
So, having read this other information, what exactly are the auditor's objectives? What are they looking for when they read the chairman's letter, for example?
Right. Having read the other information, the auditor's objectives are basically fourfold. One, to consider whether there is a material inconsistency between the other information and the financial statements themselves. Does the narrative match the numbers? Two, to consider whether there is a material inconsistency between the other information and the auditor's knowledge obtained during the audit. Does what management is saying in the report align with what the auditor found?
Okay.
Three, to respond appropriately when such inconsistencies seem to exist or when other information just looks materially misstated on its own. And finally, four, to report in accordance with SA 720, providing clarity on their findings regarding this consistency check.
How does the auditor go about achieving these objectives? What are the key practical steps involved?
Okay, first, obtaining the information. The auditor discusses with management to figure out what exactly comprises the annual report and when it's likely to be issued. The auditor makes arrangements to get the final version of the document before the date of the auditor's report, if possible.
What if they can't get it before?
If not, they request a written representation from management that it will be provided before the company issues it. Then, for reading and considering, the auditor must read the other information. While doing so, they must consider material inconsistency between the other information and the financial statements, comparing selected amounts or items, key ratios, etc., and the auditor's knowledge obtained in the audit, the understanding of the entity, internal control findings, discussions with management, TCWG.
Okay.
The auditor must also just remain alert for indications that other information, even if not directly related to the financials or audit knowledge, appears to be materially misstated in some other way.
And how do they respond if they do find an apparent misstatement or inconsistency? Do they have any teeth here?
They do. If a material inconsistency or misstatement appears to exist, the auditor discusses it with management and, if needed, performs more procedures to conclude if a material misstatement actually exists in the other information or maybe even in the financial statements themselves, if the inconsistency points back to an error there. If the auditor concludes a material misstatement does exist in the other information, they request management to correct it. If management refuses, the auditor communicates this to those charged with governance and requests correction. If it's still uncorrected and the info is obtained before the audit report date, the auditor takes appropriate action. This includes considering implications for the auditor's report, telling TCWG how it will be addressed, and potentially even withdrawing from the engagement if allowed.
And if they only get the annual report after the audit report is signed?
Right. If uncorrected but obtained after the audit report date, the auditor takes appropriate action to bring the uncorrected misstatement to users' attention, considering their legal rights and obligations. This might involve advising the company to issue a correcting statement or other steps.
Finally, what are the reporting requirements for this other information in the auditor's report? Does it always get its own section?
The auditor's report shall include a separate section with the heading Other Information or a similar appropriate heading when. For a listed entity, the auditor has obtained or expects to obtain the other information. Or for an unlisted corporate entity, the auditor has obtained some or all of the other information.
Is there an important note here about applicability for different types of entities, maybe smaller ones?
Yes, this is key for your exam prep. The full reporting requirements in SA 720 will not be applicable in the case of unlisted non-corporate entities, think partnerships or sole proprietorships.
Why not?
Mainly due to practical difficulties in reliably obtaining formal annual reports containing other information for such entities. However, it's clarified that all the other requirements of SA 720, like the auditor's responsibility to read and consider consistency for any other information they do obtain, still apply to audits of all unlisted entities. You still have to read what you get.
Okay, and the content of this section?
The content of this other information section shall include a statement that management is responsible for the other information, an identification of the specific other information obtained, a clear statement that the auditor's opinion does not cover the other information, and no audit opinion or assurance conclusion is expressed on it. This is crucial. No opinion on the other info itself.
Right.
A description of the auditor's responsibilities relating to reading, considering, and reporting on other information. And finally, if other information was obtained prior to the report date either, a statement that the auditor has nothing to report. Or if the auditor has concluded that there is an uncorrected material misstatement of the other information, a statement that clearly describes that uncorrected material misstatement. 7. Legal and regulatory requirements. Companies Act 2013 and CAR 2020, the Indium context.
Okay, now let's ground these auditing standards in the specific legal and regulatory landscape, particularly in India. What are the auditor's duties under the Companies Act 2013, specifically Section 143? This goes beyond just the essays we've discussed, right?
Yeah.
Absolutely, yes. This section adds a layer of specific statutory responsibilities for auditors in India, which are typically integrated into the audit report under the Report on Other Legal and Regulatory Requirements section. These duties include reporting on some really fundamental aspects of the company's operations.
Like what?
For instance, the auditor must report whether all necessary information and explanations were sought and obtained from the company, and if not, provide details and explain the effect on the financial statements.
Basic access check.
Right. They must also give an opinion on whether proper books of account, as required by law, were kept, and whether proper returns were received from branches. This ensures accountability for record keeping.
What about verifying the financial statements themselves against the underlying records? Is that covered?
Yes. A core duty is to report whether the balance sheet, profit and loss account, etc. are in agreement with the books of account and returns. The auditor also has to state whether the financial statements comply with the applicable accounting standards. Beyond just compliance, they need to highlight any observations or comments on financial transactions or matters which have any adverse effect on the functioning of the company, bringing critical business insights to the members' attention.
Important for governance.
Very. Another crucial duty for corporate governance is reporting whether any director is disqualified under Section 164 of the Act, and if there is any qualification, reservation, or adverse remark related to the accounts, the reasons must be clearly stated. This links right back to our SA 705 discussion.
And a very significant area in India recently has been internal financial controls, IFC. What's the auditor's role there under the Act?
Yes. A very significant duty under Section 143 is reporting whether the company has adequate internal financial controls with reference to financial statements in place and the operating effectiveness of such controls. This is a massive undertaking for auditors, often resulting in a separate, detailed report on internal financial controls, or IFC, usually presented as an annexure to the main audit report.
And there are specific disclosures under Rule 11 of the company's Audit and Auditors Rules 2014, correct?
Yeah.
What are some of those more granular reporting requirements? They seem quite specific.
Yes, Rule 11 mandates reporting on very specific matters designed to provide deeper insights into particular risks or compliance areas. Things like the impact of pending litigations on the company's financial position, whether proper provision for material foreseeable losses on long-term or derivative contracts has been made.
Okay.
Any delays in transferring amounts to the Investor Education and Protection Fund, IEPF, that's about protecting investor funds. Compliance regarding funds advanced, loaned, or invested through intermediaries to ultimate beneficiaries, which is aimed at preventing circular transactions or siphoning. Compliance with Section 123 for dividend declared or paid. And a newer, very relevant point for our digital age. Whether the company is using accounting software with an audit trail edit log facility that was operated throughout the year, wasn't tampered with, and was properly preserved.
Wow, that's specific.
It is. It's a significant step towards ensuring data integrity in accounting systems.
One of the most talked about duties for auditors is reporting on frauds under Section 143, 12, and Rule 13. How does this critical duty play out? It seems to depend on the amount involved.
It is critical, and yes, the Companies Act has very precise procedures depending on the value of the fraud. It's quite structured. First, for reporting to the central government, CG. This is triggered if the auditor has reason to believe a fraud involving 1 crore or above is being or has been committed against the company by its officers or employees.
1 crore or more, okay.
The procedure is strict and time-bound. The auditor reports to the Board or Audit Committee, AAC, immediately, but no later than 2 days of gaining knowledge of the fraud.
2 days, that's quick.
Very. The Board or AC must respond within 45 days, detailing their action plan. If the auditor receives a reply, they send their report, and the Board EC's response to the central government within 15 days of receiving that response. If no reply from the Board AC comes within the 45-day window, the auditor sends their report directly to the CG along with a note detailing the non-receipt of the reply within 15 days after the 45-day period expires.
Strict timeline.
Very. The report has to be in Form ADT4, sent in a sealed cover via registered post or speed post, followed by an email, and must be on the auditor's letterhead with all their professional details. Ensures accountability and official communication.
And if the fraud involves a smaller amount, say less than 1 crore, does it just get ignored?
No, not ignored. For reporting to the Audit Committee or Board, if the fraud involves less than 1 crore, the auditor reports the matter immediately, again, not later than 2 days of knowledge, to the AC, if the company has one, or the boarding corners in other cases. The details reported are more concise. Nature of fraud with description, approximate amount involved, and parties involved.
What about public disclosure of these smaller frauds? Are they kept quiet from stakeholders?
No, there's a mechanism for that too. Companies whose auditors have reported frauds to the AC or Board, but not to the central government, must disclose details about such frauds in their own Board's report.
Ah, so it comes out in the Board's report.
Yes, this ensures transparency to shareholders. The required details include nature of fraud with description, approximate amount involved, parties involved if remedial action not taken, and remedial actions taken. It's also important to note that Section 143.13 provides a safeguard for the auditor if the fraud reporting is done in good faith, protecting them from liability for making such a report.
And how does the definition of fraud compare between the auditing standards, SA 240, and the Companies Act, Section 447? Is there any subtle difference in scope we should be aware of?
There is a slight difference, yeah. The definition of fraud under SA 240 and Section 447 of the Companies Act are broadly similar. Both focus on intentional misrepresentation resulting in wrongful gain or loss. However, Section 447's definition is arguably wider. It includes acts done with intent to injure the interests of the company or its shareholders or its creditors or any other person, whether or not there is any wrongful gain or wrongful loss.
Intent to injure.
Right. Auditors might not always detect such intent, especially if the financial effects of those acts aren't directly reflected in the books. For example, an auditor might not easily detect if an employee is taking secret kickbacks for favoring a supplier, if those kickbacks aren't recorded anywhere in the company's accounts. So the auditor primarily focuses on frauds that impact the financial statements or involve the company's officers or employees directly against the company.
Let's turn to CRO 2020, the company's auditor's report. Order 2020. What is its nature and to whom does it apply? Is it like an extra checklist for auditors?
Yeah, CARO 2020 is an additional reporting requirement issued under Section 143.11 of the Companies Act. It's designed to provide deeper insights into specific operational and compliance aspects, kind of like an enhanced checklist, yes. It generally applies to every company, including a foreign company. However, there are significant exemptions.
Okay, can you detail those exemptions? They seem crucial for knowing when AARO applies or doesn't, especially for exams.
Absolutely. Knowing these exemptions is key. Key entities exempt from CARO 2020 reporting include banking companies, insurance companies, Section 8 companies, the nonprofits, one-person companies, OPCs, and small companies, as defined by the Companies Act.
Those are the types.
Yes, and additionally, certain private limited companies are exempt if they are not a subsidiary or holding company of a public company, and they meet specific financial criteria related to size.
What are those criteria?
Their paid-up capital and reserves are not more than 1 crore as of the balance sheet date. Their total borrowings do not exceed 1 crore from banks or financial institutions at any point in time during the financial year. And their total revenue does not exceed 10 crore during the financial year.
All 3 conditions need to be met.
For the private company exemption, yes. All 3 thresholds related to capital, borrowings, and revenue must be met or not exceeded for the exemption to apply.
So CARO 2020 mandates reporting on numerous specific matters. Instead of listing every single clause, could you walk us through some of the most impactful or commonly tested ones, perhaps highlighting why they are significant?
Certainly. CARO is quite comprehensive, focusing on areas prone to risk or needing high transparency. Let's look at a few that often come up and are significant. 1. Property, plant and equipment, PPE, and intangible assets. The auditor reports on whether the company maintains proper records, if physical verification of assets happened regularly, if title deeds of immovable properties are actually in the company's name, and details any revaluation. This is significant because PPE is often a huge part of a company's assets. Proper ownership and valuation are critical.
Makes sense.
Inventories. Here, the auditor checks if management physically verified inventory reasonably often, if discrepancies of 10% or more were properly dealt with, and if records are well maintained. Vital because inventory is susceptible to theft, damage, obsolescence, directly hitting profits. 3. Investments, guarantees, loans, advances. A crucial clause. The auditor reports if loans and advances given by the company are prejudicial to its interests, if repayment terms are regular, if amounts are overdue, and importantly, compliance with Sections 185 and 186 of the Companies Act. Those sections govern intercorporate loans and investments to prevent siphoning of funds or dodgy related party deals.
Big focus area.
Huge. 4. Statutory dues and undisclosed income. The auditor reports on the regularity of depositing statutory dues like PF, ESI, GST, income tax. Non-compliance means penalties, legal issues. They also look for any undisclosed income transactions not recorded but surrendered during tax assessments, pointing to potential tax evasion.
Okay.
5. Frauds. CARO specifically requires reporting on any fraud by the company or any fraud on the company noticed or reported during the year, linking back directly to the Section 143 duties we discussed. This also includes considering whistleblower complaints, emphasizes the auditor's watchdog role. 6. Material uncertainty on meeting liabilities. This is a relatively recent and very critical addition. The auditor gives an opinion on whether no material uncertainty exists that the company can meet its liabilities, as and when they fall, due within a period of 1 year, based on ratios, aging, management plans. This links directly to SA 570, going concern, and provides an early warning system for financial distress. Helps users understand short-term viability.
That seems really useful for users.
It is. These clauses provide specific, actionable insights into a company's financial and operational health that go beyond just the main financial statements.
Audit report versus certificate, opinion versus fact.
This is a fundamental distinction that sometimes trips people up. The difference between an audit report and a certificate.
Yeah.
Can you clarify this core concept for us? It seems important for understanding the auditor's responsibility.
It is indeed a core concept and vital for understanding the level of responsibility the auditor takes. The term report is generally used where an expression of opinion is involved. Right. It's a formal statement made after an inquiry, examination, or review, and critically, it includes the auditor's opinion based on factual data, due care, and skill. Opinions can differ between professionals because there's always a judgment element involved. For example, the independent auditor's report under Section 143 of the Companies Act is an opinion-based report. The auditor is responsible for ensuring the opinion is based on sufficient facts, aligns with evidence, and is arrived at through due care.
And a certificate, how does that differ? Is it more concrete?
Exactly. The term certificate is preferable where the auditor comments on or verifies facts. It is a written confirmation of the accuracy of facts and does not involve any estimate or opinion.
Just the facts.
Just the facts. The auditor is responsible for the factual accuracy of what is stated. There's no judgment here. It's a verifiable statement. For example, under Section 66 of the Companies Act, An auditor provides a certificate to the tribunal for capital reduction, certifying specific factual conditions are met. Or an auditor might certify the net worth of a company as at a specific date based on verifiable calculations from the books. In these cases, it's a statement of verifiable fact, not a subjective opinion. Big difference in responsibility. OAX, integrated case study and application, putting it all together for your exam.
All right, this is where it all comes together. We've covered the foundational standards, modifications, EOMs, OMs, camus merums, comparative info, other info, and the specific legal stuff like CARO. Now, let's apply these concepts to integrated scenarios, just like what you might face in your exam. We'll analyze the situation and figure out the appropriate audit reporting action using the principles we've discussed.
Sounds good. Let's dive into case scenario A, cash sales verification issue. The situation is, a company sells agricultural products, which are outside GST rules. It generates a substantial part of revenues, about 80%, through cash sales. The engagement team found no proper system and internal control to verify accuracy of revenues generated through cash sales. As a result, the team has been unable to verify such revenues generated through cash sales.
Okay, let's analyze this through the SA 705 lens. What's the fundamental nature of the issue here? Is it a misstatement or is it a scope limitation?
The nature of the issue is clearly an inability to obtain sufficient appropriate audit evidence.
A scope limitation.
Definitely. This isn't about management making a wrong accounting entry. It's about the auditor being fundamentally blocked from verifying a major component of the financials due to a lack of controls and verifiable records.
And is it material? 80% of revenue sounds, well, huge.
Oh, absolutely. Given that 80% of revenues are affected, this is undeniably material. It's a massive portion of the company's financial performance, crucial for any user's economic decisions.
Now, the critical question for SA 705, is it pervasive? Does this issue spread its impact across the financial statements, or is it kind of contained?
This is where that pervasive definition is key. Revenue is a core financial statement element, right?
Yeah.
And 80% of revenue being unverifiable represents a substantial proportion of the financial statements. The inability to verify such a large portion means the auditors just can't reliably form an opinion on the overall financial performance and position.
It undermines the whole thing.
It fundamentally undermines the reliability of the entire income statement, and by extension, the balance sheet. The source guides that the possible effects of this inability to obtain sufficient appropriate audit evidence are both material and pervasive.
Yeah.
Like trying to build a house when 80% of the foundation is just missing.
So, based on our SA 705 matrix, inability to obtain sufficient appropriate audit evidence, and immaterial and pervasive effects, what's the conclusion? What kind of opinion?
The auditor should issue a disclaimer of opinion. This is the only appropriate response when the scope limitation is so severe and so pervasive that the auditor simply cannot form an opinion on the financial statements as a whole. They just don't have enough reliable information to stand behind.
And what are the specific reporting implications for the exam in this scenario? How would the auditor actually craft the report? What are the key changes?
Okay, specifics. The opinion section would clearly state, we do not express an opinion on the accompanying financial statements of the entity.
Blunt.
Very. The basis for disclaimer of opinion section would meticulously detail the inability to verify the significant cash sales due to control deficiencies and lack of records, explaining why an opinion couldn't be formed. Furthermore, the statement in the auditor's report would be changed from financial statements have been audited to something like auditor was engaged to audit financial statements, reflecting that the audit couldn't be completed properly. And as per SA 705, the report would generally not include a key audit matters section unless legally required, because discussing specific matters contradicts the fact that no overall opinion could be formed. The description of the auditor's responsibilities would also be amended to reflect this fundamental inability to get enough evidence.
Okay, crystal clear on that one. Let's move on to case scenario B, trade secret litigation and ambiguous legal opinion. The situation. TS Limited is dragged to court for stealing trade secrets. The claim is for 50 crore. The auditor found that the legal opinion of company's standing counsel is ambiguous. There are precedent case laws both in favor and against. And crucially, the financial statements of TS Limited are silent on this litigation matter. No mention at all.
Okay, let's analyze this using the essays. First, SA 700 and SA 705. The financial statements are silent on a potential 50 crore litigation. This immediately flags inadequate disclosure. This constitutes a material misstatement, because 50 crore is likely significant, and its omission would reasonably be expected to influence user decisions about the company's risks and financial health, especially concerning contingent liabilities.
Is the impact pervasive in this scenario? Or is it more contained, do you think?
Whether it's pervasive, well, it depends on the company's size relative to that 50 crore claim. If 50 crore represents a substantial proportion of the financials, say the company's net worth is only 100 crore, making the claim 50%, or fundamentally impacts users' understanding of the company's entire financial health, it could be pervasive.
But usually,
However, litigation, while serious, is often confined to specific contingent liability disclosures. If it doesn't immediately threaten the going concern, which isn't stated here, just an ambiguous outcome, or fundamentally distort all the financials, it's typically considered material but not pervasive. For exam purposes, unless the scenario really pushes it towards pervasiveness, assume material but not pervasive is the starting point.
could an emphasis of matter, EOM paragraph under Assay 706, be appropriate here, given the uncertainty and the ambiguity?
No, absolutely not. This is a critical distinction to nail down. The source explicitly indicates that an EOM paragraph is not appropriate when disclosure is inadequate. An EOM is only for matters appropriately disclosed in the financial statements.
And here there's no disclosure.
Exactly. Here, there's no disclosure at all regarding the litigation, which makes it a material omission and therefore a misstatement. EOM is off the table.
And how do we distinguish between an inability to obtain evidence versus a material misstatement here? The legal opinion is ambiguous.
True, the legal opinion's ambiguity means there's uncertainty about the eventual outcome. But the primary issue here isn't an inability to obtain sufficient appropriate audit evidence on the existence of the litigation itself. The litigation definitely exists. The core problem is the non-disclosure of this known material contingent liability in the financial statements.
So the silence is the misstatement.
Precisely. Since the financial statements are silent on a material matter that requires disclosure, it's a factual misstatement due to omission.
So what's the conclusion on the type of opinion based on our source guidance and principles? What should the auditor do?
Okay, this scenario really tests that distinction between EOM and modification. Since the financial statements are silent, meaning there's inadequate disclosure of a material matter, this points squarely to a material misstatement.
Right.
Assuming 50 crore is material, but not pervasive to the financial statements as a whole, i.e. it's a significant omission but doesn't break the entire financial picture, the most appropriate opinion would be a qualified opinion.
Qualified, okay.
The auditor would state that, except for the effects of the matter described in the basis for qualified opinion section, regarding the undisclosed litigation, the financial statements are presented fairly. The basis for qualified opinion section would then detail the nature of the litigation, its significant amount, the ambiguous legal situation, and crucially, the lack of disclosure in the financial statements. This really highlights the power of that SA 705 matrix and definitions. Understanding material versus pervasive is just absolutely key.
Absolutely. It all comes back to that decision matrix. Let's try another one, keep the momentum going.
Okay, case scenario C. Change in accounting policy for inventory inappropriate application. The situation. A manufacturing company changed its inventory valuation method from FIFO to weighted average during the year. Management says this gives a better measure of costs. However, the auditor finds that this change wasn't made to comply with a standard or to present info more reliably, but seems primarily aimed at minimizing tax liability in a period of rising prices. The impact on profit is material 15 crore, which is 10% of total profit. Importantly, this change is disclosed in the notes.
All right, applying our SA 705 lens, what's the nature of the issue here? Disclosure is there, but...
Right. Disclosure is there, but the reason for the change and its application are inappropriate. This is a material misstatement.
Why a misstatement if it's disclosed?
Because the change isn't in accordance with the applicable financial reporting framework. Frameworks generally require changes in accounting policy only if mandated by a standard or if they genuinely result in more relevant and reliable information. Using it purely for tax minimization without proper justification constitutes a departure from the framework. That departure leads to a misstatement in the reported profit and inventory figures, even if the fact of the change is disclosed.
Is the misstatement material of 15 crore at 10% of profit?
Yes, definitely. The impact on profit is 15 crore, 10% of total profit. This is clearly significant enough to reasonably be expected to influence the economic decisions of users, so it is material.
Now, the pervasiveness question. Is this change pervasive, or is it more confined to inventory and profit?
While it impacts profit, a key figure, this misstatement is related specifically to inventory valuation and its effect on the cost of goods sold. It's a specific accounting policy departure. It doesn't fundamentally break the entire financial picture or affect all elements across the statements in a way that distorts the whole thing. So it is material but not pervasive.
So based on our SA 705 matrix, material misstatement and material but not pervasive effects, what's the conclusion on the type of opinion?
The auditor should issue a qualified opinion. The financial statements are fairly presented, except for the effects of this inappropriate accounting policy change.
And what are the specific reporting implications for the exam in this scenario? How would the basis for qualified opinion read?
The opinion section would state, in our opinion, except for the effects of the matter described in the basis for qualified opinion section, the accompanying financial statements present fairly.
The basis for qualified opinion section would need to detail the specific accounting policy change, fee-photo weighted average, explain why it was deemed inappropriate by the auditor, i.e. not meeting the criteria for a voluntary change under the FRF, appearing driven by tax rather than approved reporting, and quantify the material impact on the financial statements mentioning the 15 crore effect on profit. It would also implicitly highlight that disclosure alone isn't enough if the underlying accounting is flawed. Okay, let's consider case scenario D. Inability to verify opening balances for a new audit engagement. The situation. You've just been appointed as the first-time auditor for a small private limited company, Alpha Solutions PVT Ltd, for the year ended March 31st, 2023. The company started 2 years ago, but its financials for the previous 2 years, ending 20X1 and 20X2, were never audited. Because of inadequate accounting records for those prior periods, you are unable to obtain sufficient appropriate audit evidence about the opening balances of inventory, which is 25% of total assets, and property, plant and equipment, PPE, both significant for the current year's results.
Okay, first-time audit, unaudited prior years. What's the nature of the issue here, using our SA 705 framework? Scope limitation.
Yes, this is clearly an inability to obtain sufficient appropriate audit evidence. You're missing reliable information about the starting point of the financial year for key accounts, which directly impacts the current year's numbers. It's a scope limitation imposed by circumstance, the lack of prior audits, and poor records.
Is the issue material? Inventory at 25% of assets plus significant PPE.
Yes, inventory at 25% of total assets and significant PPE are definitely material to the financial statements. The lack of verifiable opening balances for these substantial items means you can't be sure about the current period's cost of goods sold from inventory, or depreciation expense from PPE, or even the accuracy of the closing asset values.
And the pervasiveness. Does this problem spread throughout the financials, or is it somewhat contained? This feels tricky.
It is tricky. While inventory and PPE are material, the inability to verify opening balances for these specific asset classes, while significant, might not always be considered pervasive to the entire financial statements as a whole.
Why not?
If other areas like cash, receivables, liabilities, and the current year's transactions for revenue and expenses are fully verifiable, the problem is somewhat contained. The current year's activity might be well recorded, but the starting point for certain major assets is cloudy, so it's typically treated as material, but not pervasive. Now, if the opening balance issue was so bad it fundamentally undermined all aspects, like the company's ability to even prepare reliable current financials at all, then it might become pervasive. But here, it seems focused on specific asset classes.
So, based on the SA 705 matrix, inability to obtain sufficient appropriate audit evidence, A&D material but not pervasive effects, what's the conclusion on the type of opinion for Alpha Solutions?
The auditor should issue a qualified opinion. You can express an opinion on most of the financial statements, but you have to carve out the potential effects of the unverifiable opening balances.
And what would be the specific reporting implications for the exam? How does the report handle this?
Okay, reporting. The opinion section would state, in our opinion, except for the possible effects of the matter described in the basis for qualified opinion section, the accompanying financial statements present fairly.
Possible effects, because it's a scope limitation?
Exactly. The basis for qualified opinion section would meticulously detail the inability to obtain sufficient appropriate audit evidence regarding the opening balances of inventory and PPE for the current period, explaining it's due to the unaudited prior years and inadequate records. But there's more.
What else?
Crucially, the auditor would also need an other matter OM paragraph under SA 710, comparative information. This OM paragraph would explicitly state something like, the financial statements of Alpha Solutions PVT Ltd. For the 2 years ended March 31st, 20X1 and March 31st, 20X2 were not audited, and accordingly, no opinion is expressed on those corresponding figures presented for comparative purposes.
So a combination of qualified opinion and an other matter paragraph.
Precisely. This combination addresses both the opinion modification for the current year due to opening balance issues and the necessary context about the unaudited prior periods presented as comparatives. Let's take one more, maybe push the boundaries a bit. Case Scenario E. Non-compliance with a major environmental regulation. The situation. Green Tech Innovations Ltd. runs a manufacturing plant generating significant industrial waste. During your audit, you discover the company hasn't complied with the critical environmental regulation on waste disposal for the entire financial year, even though management knew about it. Non-compliance could lead to severe penalties up to 200 crore and potential plant shutdown. Neither of these potential outcomes has been disclosed or provided for in the financial statements. The company's net worth is 500 crore. And non-compliance, huge potential penalties, no disclosure. What's the nature of the issue here, according to SA 705? This is a material misstatement. The financial statements are silent on a potentially massive contingent liability, the penalties, the shutdown risk that requires disclosure and possibly provision under the FRF. This omission is a direct departure from the framework's requirements.
Is the issue material? 200 crore penalty against 500 crore net worth.
Oh, absolutely. Potential penalties of 200 crore against a net worth of 500 crore is 40% of net worth. This is undeniably material and would significantly influence any user's decisions. The potential for plant shutdown also points to a fundamental threat to the business itself.
Now, the crucial pervasiveness question. Is this material issue also pervasive? Does it taint the whole picture?
Yes, I would argue in this specific scenario, it's likely both material and pervasive.
Why pervasive here?
While it originates from an environmental noncompliance, the potential penalty of 200 crore, 40% of net worth, coupled with the risk of plant shutdown, is fundamental to the company's financial viability and its ability to operate at all. A plant shutdown would impact literally everything: revenue, expenses, assets, liabilities, the going concern basis itself. It represents a substantial proportion of the financial statements and is absolutely fundamental to users' understanding of the entity's ability to continue. This isn't just a misstated balance, it's an existential threat that's been ignored in the financials.
So based on the SA 705 matrix, material misstatement, ND, material and pervasive effects, what's the conclusion on the type of opinion for Green Tech Innovations Ltd?
The auditor should issue an adverse opinion. The financial statements are so fundamentally misleading due to the omission of this severe noncompliance and its potentially catastrophic consequences that they simply are not presented fairly.
And what are the specific reporting implications for the exam? How does an adverse opinion get worded?
Right. The opinion section would state something like, in our opinion, because of the significance of the matter discussed in the basis for adverse opinion section, the accompanying financial statements have not been prepared, in all material respects, in accordance with the applicable financial reporting framework.
Very strong wording.
Extremely. The basis for adverse opinion section would then meticulously describe the non-compliance with the environmental regulation, the potential for the 200 crore penalties and plant shutdown, and management's critical failure to disclose or provide for these matters. It would need to clearly explain why this omission is considered both material and pervasive, driving the adverse conclusion. This is a very strong, very serious message to the users that the financial statements basically cannot be relied upon.
These case studies truly bring the decision matrix to life. It really is all about methodically assessing materiality and then pervasiveness, isn't it? Outro.
It really is. So, yeah, we've journeyed through this really intricate landscape of the independent auditor's report, haven't we?
Yeah.
From the fundamental objectives of SA 700 all the way to the critical distinctions between the modified opinions under SA 705. We explored how SA 706 lets auditors flag important stuff with EOMs and OMs, how SA 701 enhances transparency through CAMs, and the specific considerations for comparatives and other info under SA 710 and 720. And we anchored it all in the legal context like the Companies Act and CRO 2020 and tackled those exam-style applications.
Yeah, and the key takeaway for me and hopefully for you listening is that the auditor's report is so much more than just a piece of paper. It's really a testament to professional judgment, that skepticism we talked about, and just meticulous evidence gathering. It's the auditor's voice, intended to provide clarity and instill confidence for countless users relying on that financial information. And for you, if you're studying, understanding the specific language, the principles of materiality and pervasiveness, and the distinct purposes of each reporting element that's going to be your superpower in any case-based exam.
Absolutely. As you continue your preparation, I'd really encourage you to revisit these concepts, specifically focusing on the precise definitions and, like we just did with the case studies, hammering home that decision-making matrix.
Practice makes perfect.
Definitely.
Yeah.
Practice dissecting scenarios like the ones we discussed. Keep asking yourself, is it material? Is it pervasive? Is it a misstatement or a scope limitation? Is it adequately disclosed? Your ability to articulate these distinctions using the correct terminology will be invaluable, not just for exams, but for your whole career in finance or accounting.
And as we wrap up, here's a provocative thought for you to maybe chew on. In a world that's increasingly driven by real-time data, by AI, how might the traditional form and content of the independent auditor's report, with its emphasis on historical financials and these structured opinions, how might that evolve? How can it meet the accelerating demand from stakeholders for more dynamic, maybe even more forward-looking assurance? What stands out to YU?